So we're seeing negativity coming to the fore. What is your view with regards to how the market is going to respond to a lot of the earnings that we're expecting? I know that banking numbers are really highly anticipated by all investors.
Sure, I would say if you look at the market as a whole, you could say that the performance of the ESI has been quite poor. But I think if you distill into the performance and isolate the banking sector, you see that there's been better performance from the banks. And like you rightly said, it's in anticipation of the performance of the banks. And based on our estimates, we expect that EPS for these banks would grow, for our coverage banks, should grow by about 17%. And in terms of dividend payout as well, we expect to see strong dividend payout. And so we expect, in terms of dividend yield for our names, to still, even despite the recent price appreciation, we still expect an average dividend yield of about 7.5% for our coverage names, and with the likes of Skybank still topping at about 12%. And I would say if we look at our highly favored names, we still expect to see strong dividend yields as well. For First Bank, which is one of our top picks, despite the over 40% rally that we've seen over the last couple of weeks, we still expect, based on our estimates, a dividend yield of about 8%, while for GT, dividend yield of 8.5%, and for Zenith Bank, we expect a dividend yield of about 8% as well. So I would say for investors that haven't come into the market, I still think it's not too late to get in and still enjoy the strong yields. And I would say if you compare it with the fixed income market and the treasury bills, you could argue that the yields are not as attractive. But also, if you factor in the potential price appreciations gains, you could benefit as well. I would say it's still a good bargain for investors.
Well, yeah, I'm glad you mentioned that, because it seems that a lot of investors, and this is what we've been hearing, that they've actually been dumping equities and moving more towards the fixed income space because there is a much higher yield within the space. UBA perhaps shocked the market somewhat with regards to their full year results. Are you saying that we'll actually see quite strong numbers going forward from the other banks? Let's just touch on First Bank, for example. You mentioned 8% dividend yield that you're expecting there. Let's drill into those numbers and what your expectations are.
I'd say in terms of expectations, we expect a strong improvement in ROEs for First Bank. We expect ROEs to improve to about 15% from 10% in 2010. And even though it's still a reduction from its Q3 numbers, as our Q3 ROEs for First Bank was at about 17%. So year on year, we expect to see stronger performance, even though we expect softer performance in Q4. And I would say it's really driven more by the loss we might expect, loan loss we might expect from the transfer of Zenon to Seawolf, I beg your pardon, to AMCON. And so the expectation is that the haircut would be between 5 to 10%, and so we expect to see some loss from that. But I would say overall, in terms of performance, we expect to see stronger performance. In terms of cost-to-income ratio as well, we expect to see stronger cost-to-income ratio. Our estimate is for about 57% for First Bank from 64 in 2010. So I would say, in terms operationally, we expect to see stronger performance from the name. And also, if you look at asset quality as well, with the sale of Seawolf to AMCON, we don't expect to see concentration risk in that name. And so we think that improves the attraction for the name. And also in terms of share price performance, year till date has been quite strong. As at the time we published our report in early January, based on our price targets, upside was as high as 90%. Now it's down to about 48%. So we've seen strong performance in the name. And also, if you consider the fact that we expect to see stronger earnings going forward, we think that that's a comfort for investors.
Muyiwa, let's also just touch on GD Bank. We've got an 8.5% dividend yield. This is what you're also expecting. And Zenith also, when you look at the earnings per share number for 2011, you're expecting, I think, 1.87 versus the 1.19. So pretty much in line with the average that you were alluding to. Is this the kind of bank that you would want to have exposure to? We know that you mentioned First Bank, GT Bank, and Zenith. Do you have all these three stocks in your portfolio, and would Zenith then take a big chunk of that?
So in terms of our preferred picks, over the last, I would say, 9 months, we've favored these three names. And I would say in terms of share price performance as well, they've been quite resilient, despite the fact that we've seen very poor performance from the sector as a whole. As that, based on last year's share price performance, the sector was down about 45%, and we still saw Zenith and GT especially still hold ground. GT's price performance was flat, Zenith was slightly low, and I would say it's still based on the performance we've seen in these names. We've seen stronger asset quality for GT. As at Q3, NPLs was down to about 2.7%, and the outlook is that it will still continue to improve as these banks focus more on risk management, and also as they try to improve efficiency as well. Based on our looking at our coverage, GT has been the best in terms of efficiency. Cost to income ratio has been quite low. Our estimate is for it to be down to about 52 for 2011 and even lower for 2012 as well. So in terms of efficiency, still expect to see these banks hold forth well in terms of efficiency.
You mentioned cost to income ratio. Just let's touch on that. What number are you comfortable with across the board?
I would say in terms of, for our coverage average, our estimate is for cost to income ratio to reduce about 66 by 2012, even though for 2011 the average is for about 74%. But I would say in terms of a comfort level is for between 50 and 55%, because I would say at that level a bank will be able to perform at least 20% ROEs, and we think that's a very good target for banks to have.